The ASX 200 closed up 1.62% on Friday, but the event that produced that gain has not yet legally happened. Reports emerged that the US and Iran reached a tentative deal to extend their ceasefire by 60 days and resume shipping through the Strait of Hormuz. But President Trump has not signed it, and Iranian state media said the agreement is not finalized. That gap between the reported deal and the actual deal is where today's entire rally lives. The strongest buying came from gold miners and the broader materials sector. Northern Star Resources gained over 5%, Evolution Mining rose 5.2%, and the ASX All Ordinaries Gold Index surged 4.5%, not because gold production economics changed, but because a tentative peace signal compressed the geopolitical risk premium that had been baked into oil prices and energy costs. Brent crude dropped toward $92 a barrel on the news. The ASX 200 recovered a large portion of Thursday's $45 billion wipeout in a single session. That recovery speed is the part worth examining. Institutional buying into the materials sector absorbed what had been broad-based selling the day before. From price and volume action, the rotation back was driven by domestic long-only funds re-entering positions they had reduced, rather than by new foreign inflows entering the ASX. The gold sector's 4.5% single-day move exceeds what a $92 oil price alone would mechanically justify. The gap suggests that positioning had been more defensively structured than the underlying macro warranted, and the ceasefire report gave local funds a trigger to unwind that defensive skew. UBS trimmed its year-end gold price forecast from $5,900 to $5,500 per ounce this week, still 26% above last December's close, citing elevated U.S. two-year Treasury yields as the near-term headwind, while maintaining that Fed rate cuts later in 2026 would restore gold's upward path. That revision is not a bearish call. It is a recalibration of how much of gold's prior geopolitical premium is now being repriced as transient rather than structural. The materials rally today priced the transient scenario. Whether that holds depends entirely on whether Trump signs.
The ceasefire headline moved the index, but one domestic stock moved for a different reason entirely, and the difference matters for reading the day's capital flows. Judo Capital Holdings jumped 12% after pricing a $750 million capital relief securitization backed by small and medium enterprise loans. The deal lifted Judo's Common Equity Tier 1 ratio from 12.6% to a pro forma 13.2%, and the company estimated a 25 to 30 basis point boost to return on equity for the 2027 financial year. Investors pushed the stock to its best session in months before the final close. The mechanism here is not sentiment or macro relief, it is capital structure efficiency. Judo generated the move by finding a cheaper way to fund existing loan exposure without holding capital against it. The transaction priced at a weighted average of 171 basis points over BBSW, compared to 273 basis points on its inaugural securitization in September 2023. That 102 basis point improvement signals the investor market's confidence in Judo's SME loan book quality. Domestic and international buyers upsized the deal from $500 million to $750 million, absorbing incremental supply without spread widening. The key positioning implication is that Judo's capital release was not priced by the market before today's announcement. The stock's 12% move implies the funding cost improvement and ROE accretion had not been discounted. The prior consensus was that Judo would need to hold capital proportionate to loan growth rather than securitize it. The same geopolitical backdrop that drove gold miners higher today produced a distinct capital direction in the defense sector, one that does not require Trump to sign anything. Drone Shield shares rose 11% after Bloomberg reported the Trump administration is actively exploring funding mechanisms for domestic drone technology companies. The report did not name Drone Shield specifically, but the company's Q1 2026 results, $74.1 million in revenue, up 121% year-over-year, with $222.8 million cash and no debt, placed it as the most direct ASX beneficiary of any U.S. counter-drone procurement expansion. Electro-Optic Systems gained 17% to a record high on the same session. The difference between the materials rally and the defense rally is the dependency structure. Materials and gold miners today priced a scenario, the signed ceasefire, that has not yet materialized. The defense stocks priced a trend, U.S. military drone and counter-drone capex expansion, that is already budgeted in the enacted appropriations request at $75 billion and does not require any Iran deal to continue. Drone Shield's 163% gain over the past 12 months is built on delivered revenue and cash flow, not on positioning for a future event. Today's 11% move added a further re-rating leg from the U.S. government funding catalyst. The capital flow divergence within the ASX today therefore splits the rally into two structurally different components. The first, materials gold miners, is headline contingent and reverses if Trump's signature does not follow. The second, defense technology, is CapEx cycle driven and remains intact regardless of the Iran outcome. Investors holding the ASX 200 rally as a unified geopolitical relief trade are exposed to only the first component unwinding. The verification point is straightforward. If Trump announces he will not accept the current deal terms, as Treasury Secretary Bessent signaled on Friday, listing Hormuz reopening and uranium surrender as preconditions, watch whether the 4.5% gold, while Drone Shield and electro-optic systems hold their ground. That divergence would confirm the two components were priced on separate premises all along. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.